the accounting reg accounts. I want to remind you on what we did on the reg accounts as far as the rules of recording transactions in the reg accounts are concerned. We said that in a business organization, we have the following accounting elements. We have the elements on what we refer as the assets. These are the resources that are owned by the business. Any resource that is owned by the business, we normally refer to it as an asset. And we said that assets are categorized into two. We have those assets we call current assets, and we have those assets we call the fixed or non-current assets. The fixed or non-current assets are those resources the business will own, and they are going to be used in the business in generating revenue for a long period of time, more than one financial year. These are the items we buy with no intention of reselling them. They include things like the motor vehicle, the furniture, the buildings. We also have things like the computers, equipment, machines. We are buying them with the intention of using them in the business in generating revenue or to assist in the smooth running of the business. No intention of selling them. So once we buy them today, we are going to use that asset for a long period of time. We call it a fixed or non-current asset. So then we have these assets we call the current assets, which are the resources the business will own for a short period of time. Things like the cash in hand, the cash at bank, the inventory, the accounts receivables or the debtors, the prepaid expenses. Those are the resources. Yes, these resources are ours, but they are going to be ours for a short period of time before they exchange hands. We call them the current assets. Regardless, when we talk about the assets, as far as the reg accounts are concerned, increase in assets we debit. For assets, we debit increase, then we credit. What do we mean by that? Whenever the assets in the business are increasing, we debit that asset that is increasing. The assets are going to increase in the business when the business is acquiring them. When the business is acquiring them. Like, for example, we buy a furniture. Furnitures will be increasing in the business, so we debit furniture account. When we buy a motor vehicle, we debit motor vehicle account because that asset will be increasing in the business. When maybe we sell goods on credit to a particular customer, that is our resource. That is increase in the debtors' balances. We debit the debtor who has acquired the goods on credit from the customer. So increase, we debit. Decrease, we credit. Decrease comes maybe as a result of selling an asset. We credit that asset account and things like that. But remember, we said that assets by the name inventory, we don't maintain inventory account, but instead we normally have the two accounts, the purchases and the sales. When inventory is bought, we debit purchases. When inventory is sold, we credit sales. Don't forget that. We don't have stock account. We don't have goods account, but instead we are going to have the two. Purchases to record the acquisition of stock, and then sales to record the selling of stock. So note that. Increase in asset we debit, decrease in asset we credit. Liabilities. These are the business obligations, the business debts. The business debts. Anytime you borrow something, or anytime you acquire something on credit, you have created a liability to the business. Anytime you borrow or you buy something on credit, a liability has been created. In that case, you credit the liability when increasing, you credit increase in the liability, and then you debit when the liabilities decrease. When a liability increase, you credit that liability account. When the liability decrease, you debit that liability. So liabilities are going to increase. Like, for example, I buy goods from you on credit. If I buy goods from you on credit, you are now my liability. I will credit your account. I will credit your account. If I put it the opposite way, if you buy goods from me on credit, you have bought goods from me on credit, I am now a liability to you. You are going to credit my account. So we normally credit the accounts of those business organizations or individuals from which we have acquired items on credit. That is increasing the liability. And then when we pay them, we are going to debit them because that liability has decreased. When you pay somebody, the debt has gone down. So you debit that account or the account for that particular individual. And that is the same case with the capital. Credit increase in capital, debit decrease in capital. Debit is a decrease in capital. Capital increases when we have invested in the business. When we introduce money into the business, when we bring in furniture into the business from something that was personal as an owner, then you convert it into business asset. You credit capital, then you debit the asset that you have brought to the business. So increase in capital, we credit. And when the business is starting, the owner normally brings the resources into the business. We credit capital, we debit the resource that has been brought into the business. Then we have these items we call expenses. Don't want to trouble you much. Debit, anytime you are paying this expense. Anytime you are paying an expense, debit that expense. Debit that expense. Expenses are debited anytime we pay them. Anytime we pay them. They normally argue that an expense is a very temporary asset. An expense is a very temporary asset. So in that case, you debit them anytime you are paying them. Because when you pay something like rent, which is an expense, in simple terms, it means that you are acquiring that space where you are paying rent for maybe a month because you are paying the rent on a monthly basis. If you have a shop, that space you pay rent, it is like you are buying that space or that space in the building for 1 month. So it is an asset to you. But now, because it is a very temporary thing, we consider it as an expense. So expenses are very, very temporary assets that you acquire for a very short period of time. When you pay salaries and wages, it is like you are buying the skills, you are buying the knowledge of that particular employee just for a month. That is the expenses. So they are assets, but I don't want you to take expenses as assets, but I want you to note that you are buying something, but on a very temporary basis. Then you debit this. Anytime you pay expense, you debit that expense. You don't have a general account for expenses. So we are going to have rent account, salaries account, insurance account, electricity account, repairs account. Every expense we have its own account, but generally all expenses are debited anytime we pay them. Then we have revenues. These are the sources of income. They are sources of income. So we normally credit them anytime we get revenue from them. This is when receiving. When receiving revenue from those sources, we credit those sources. It can be discount received, that is a revenue account. Actually, even sales is a revenue account, we credit it. We normally have the commission received account, interest received account. All those are normally credited anytime we receive revenue from them. Then we have the purchases I've told you, but let me repeat. The purchases, it is going to be debited when we acquire goods. When we have the increase in stock. Then sometimes we credit it when we have the decrease in stock. And this one is going to appear only when the owner has taken the goods for personal use. When we have the drawings, the owner takes part of the purchased goods for personal use, we shall credit purchases because the items that were meant for business have been reduced. So this, instead of debiting goods or stock account, we debit purchases. Anytime we increase stock into the business. Then we have the sales account. These are the accounts that are commonly used. This one we normally credit when stock decreases. When stock decreases, or let me say when stock is sold. Not decreases, when stock is sold. Anytime we sell stock, you credit this sales account. Credit sales account. So selling goods, credit sales account. Regardless, don't bother to know how they were sold, whether it was by cash or by check or on credit. Sales will always be credited. Sales will always be credited. Purchases when buying goods will always be debited. So I want you to understand this so that when we go to the errors, and then we find a case whereby we are told that the sales account was debited, you need now to understand very fast that it was supposed to be credited. So we correct it very fast. Yeah? Then we have the returns. We have the purchases returns. This is always credited. Purchases returns is the same as return outwards. It is the same as the return outwards. Then we have got the sales returns. This is always debited. And what goes there? False returns, when goods are being returned. When goods are being returned, we normally capture them into either purchases returns or sales returns. When we are the ones returning to the suppliers, it becomes purchases returns because from suppliers we have purchased, now we are returning them. So we credit the purchases returns anytime we return goods back to the suppliers. Sales returns is always debited, and this occurs when customers return goods to the business. When customers return goods to our business, the goods that we had initially sold to them, they become sales returns, and those goods are going to be debited in the sales returns account. Then maybe lastly, we have the drawings account. The drawings account, we have said it is an account where anytime the owner takes goods or any resource from the business for his or her own personal use, we are going to record that. So the drawings account is going to be debited always. The drawings account is always credited, always credited with the value of the resource the owner has taken for personal use. That is it. Those are now the rules of recording the transaction. And when recording the transactions in the ledger accounts, always remember the rule of the double entry must be observed. The rule of double entry must be observed. For every debit entry, there must be a corresponding credit entry. For every debit entry, there must be a corresponding credit entry. So that is it. So there's a document I shared with you. There's a document I shared with you. I want you to have a look at it. Those are the past paper questions. Actually, June this year, the question was tested, and that is the first question that is in that document. That question was tested in the old curriculum, CHRP 04, in June this year. That is just the exam that was tested the other day. So the question was saying that the following transactions were extracted from the books of Pendo Enterprises for the month of May 2021. So we have the transactions at the dates. May 1st, started the business with 200,000 in cash, 90,000 in the business account. Obviously, I've told you that money to start or any resource used to start the business or introduced into the business is capital. So we shall credit capital with the 200,000 and the 90,000. Then we shall debit the assets. The assets here is cash account and the bank account. On that, bought furniture for 50,000 shillings from Home Furniture Limited on, it's supposed to be on credit. The problem with this CHRP papers is like they don't do moderation before actually bringing them to the exams. It is supposed to be on credit. So in that case, we have said anytime you buy something on credit, whoever sold that item to you is a liability, so you credit that account. So we shall credit the Home Furniture Limited because that is a debt to them, and then we debit the asset we acquired, which is furniture. Paid rent, 50,000 by check. Rent is an expense. Anytime you pay rent or you pay an expense, you debit that expense. So we shall debit rent account and then credit the bank account because that is asset. Asset bank will be reducing by 50,000 as a result of paying the rent. Debit rent, credit bank. 9th, board stock. Anytime we said you buy stock, you debit purchases, but it was on credit from Zuri. So we shall debit purchases, then we credit the liability, which is now Zuri account. Sold goods, we said it always goes to sales, credit sales account, and then here you will debit cash because cash will be received from the sales. Credit sales, debit cash. 14, the goods worth 4,000 were returned. The problem there again, they are not telling us. Is it who returned the goods? They don't tell us, or they didn't tell the candidates who returned the goods, or to whom did we return the goods? So did we return the goods to Zuri, or is it goods that were returned by the customer, and who is that customer? So that is a challenge. But because from the look of things, the only goods that or stock items here is on 9, whereby we bought from Zuri. We have not sold anything. We have not sold anything, so we just assume that we returned goods to Zuri. We returned goods to Zuri because the other one was in cash. Otherwise, the question needs to be very specific. We returned goods to this, or this customer returned goods to the business. It was not specific, but we consider it to be returns for the date 9. 14, the goods worth, okay, that is the statement. 17, bought stock on credit for 100,000 from MEMA. So when you buy, anytime you buy stock or goods, debit purchases, then we credit the person who sold it to us with MEMA. In that case, it is a liability. Borrowed 120,000 from Fanizi. When you borrow or buy and credit, a liability will be created. So Fanizi Bank is going to be our liability. We credit Fanizi Bank, then we debit. Again, here they did not tell us whether it was borrowed by cash or by check. So we shall put in one of them. Nobody will penalize you when they are not clear, but put it in the bank account. We withdrew 50,000 from the bank for provisional use. Another error. It is supposed to be for personal use. So this paper was full of issues. We withdrew 50,000 from the bank for personal use. And in that case, drawings account will be affected because we have said anything taken from the business for personal use must be debited in the drawings account. So we shall debit the drawings account, then we credit the bank because that drawings was made from the bank. That is it. Let us do it now on the board. So started the business capital account. So those three accounts will be affected by that first transaction because money or capital is introduced. This capital, part of it is in cash, part of it is in the bank. For capital account, anytime capital is introduced in the business, we credit capital account because capital will be increasing. So we come here and record the date. 2021, 1st of May. Part of this capital is in cash, 200,000. Part of it is the bank. The cash amount is 200,000. The money in the bank is 90,000. Both, they are capital. We credit them in the capital account. Then it simply means that the cash box of the business will be receiving the 200,000 from the owner. So anytime cash or bank is received in the business, we debit them. We debit cash or bank anytime we receive. We debit. We receive cash, debit. We receive a check, debit bank. So cash here will be debited. Capital. Bank will also be debited by capital. The bank amount is 90,000. So you debit with their respective amounts. That is sorted. That is transaction for the first May. For the first May. Increase in capital and increase in the assets. Increase in capital credit, increase in asset debit. Double entry has been observed. Done. Bought furniture for 50,000 from Home Furniture Limited on credit. So here, anytime a liability is created, there must be an asset that has been acquired. There is no way you can create a liability without receiving an asset. There is no way you can have a debt without receiving something. A debt comes as a result of getting something on credit. So you debit what you acquired and increase in asset in that case is debited. Debit what you have bought, credit the person who has supplied the item to you. Because the person becomes a liability, then there is an asset that you need to debit. So come here. So this is an asset being received. From Home Furniture. $50,000. To credit the Home Furniture, which is the liability like that. Remember, the names of the ledger accounts may interchange. In the furniture, you write here how it was acquired or from whom. Home furniture is a liability. Liability as a result of what? As a result of the furniture you bought. Like that. That is okay. We go to 8, where we paid rent. Have the rent account. Rent is an expense. Anytime you pay an expense, debit that expense that you are paying. So we shall have 8th of May. This expense was paid by check, so it is going to affect the bank. Remember, we don't have check account. Checks go to the bank. So anytime check is mentioned, just know that that is a transaction affecting bank. Then this rent was paid by bank, meaning that in the bank, there is money moving out with credit bank by rent. Credit bank Anytime money is moving out, you credit cash or bank. 9, both stock, that is purchases. Both stock or credit from Zuri, so we shall have this liability of Zuri account. So we said that anytime goods are bought, debit the purchases. Right here, Zuri, 60,000. Zuri is the liability with credit, 9, we write here purchases. Eleven, sold goods for 40,000 in cash. When you sell goods, sales account will be affected. These goods were sold by cash. Sales account should always be credited. Don't forget that. By cash. What does that mean? To cash? To cash, it is money received because we have sold goods. The customers are paying us. Debit cash account. Debit cash account. Coming from sales. 40,000. 14, goods worth 4,000 were returned. We have agreed, let us treat them as purchases returns to Zuri. We had purchased goods from Zuri here. From Zuri, we had purchased goods because we don't have any other transaction that was made to a customer. Let us treat it as purchases returns to Zuri. So just open the purchases returns account. This one we have said it is always credited. Always credited. You credit using the name of the supplier to whom you have returned. So this was 14 May. Have returned goods from Zuri of 4,000. What does that mean? We had a liability of 60,000 to Zuri. When we return goods to that particular supplier, the liability reduces because we cannot pay for the goods that we have returned. So we debit that liability account or the creditor's account. Right here, purchases returns. Of 4,000. We are reducing by 4,000, which is as a result of the purchases returns. That is what we do. We credited a liability of 60,000, but that liability is reducing now by 4,000 because we have returned the goods. If I return goods to you, you cannot charge me for the goods that I have returned. So I reduce the liability by debiting. Increase in liabilities with debit, but decrease with debit. So anytime you are debiting a liability account, you are reducing that liability. Anytime you are crediting a liability account, that liability is increasing. That is on 14th, and then on 17th, both stock, that is the purchases. You already have the purchases account. This is on 17th from MEMA. The value of stock bought from MEMA, 100,000. Then we need to have an account for that supplier who is now going to be a liability to us. We need to have MEMA account. MEMA account you credit because this is a liability. $100,000. Credit the liability name account by $100,000. 20th borrowed $120,000 from Fanisi Bank. We said we consider that money to have been received in by check. So you are going to open the liability of Fanisi Bank account. You credit. In the liability account, you credit. Here we shall come and say 20th of May, bank 120,000. The liability of 120,000 because of the check that they gave us in the form of a loan. So you credit that liability. Remember, liability, when created, there must be an asset received. So the asset that you received is the money that, or the check that was deposited in the bank. 20th of May, and easy. 120,000. 120,000 was received in our bank account. So there is an asset that we acquired as we create a liability on the other end. And it's a double entry. Lastly, we withdrew 50,000 from the bank for personal use. To the bank, it is going to be money out. You credit the asset, bank balance will be reducing. I want drawings. There is drawings of 50,000 made from our bank account. Therefore, it means that we need to open the drawings account. Debit. 30th of May, it was from the bank. That is all. In posting. So I give you a tip. In an examination scenario, when you are told to prepare the ledger accounts and you feel like time is not on your side, you can just post and read them like that. When the time is not on your side, just post them, continue with the other question first. But you are supposed to balance them. You are supposed to balance them. So you can post them, continue, and then you balance them later. But if time is not on your end, don't struggle balancing. Balancing does not have a marks, does not have a lot of marks. You can find balancing can be even 2 marks. So don't struggle too much. Yes.
Allow me to see the end part of the board. The Fanisi. Yes.
Okay. When you go to an examination, just go there with the motive of maximizing the marks. The 10 minutes you can spend in balancing these accounts can be used to earn you maybe even 10 marks. The furniture account. I hope you are done with the other end.
Yes, Mwalimu, thank you.
The furniture account. Furniture account is there. And note that it becomes very easy when you do it simultaneously. Yeah? When you copy them like this, now that I've prepared, you copy them, you might not understand what was happening. But when you do it literally yourself, you open this account, you debit, you open the other one, you credit simultaneously, you understand it better. But when you copy this, it might sound as if it is you are just copying, you don't know what happened. But when you are doing it the same time I'm doing it, you get to understand it better. You get to understand it better. But always note, when preparing the ledger accounts, the rule of double entry must be observed. The dual aspect concept. For every debit entry, there must be a credit entry of the same amount. So, because we are revising, I want us to go ahead and balance these ledgers and balance these ledgers.
Mwalimu, a quick one.
Yes.
On sales return or on purchases return,
Yes.
would you please come again on that one?
These are the value of goods returned. So it can
Yes, sir.
either be sales returns. When it is sales returns, it means that I have sold the goods to you, but you have returned to me some of the goods. Maybe I said to you goods worth 3,000. You returned to me goods worth 1,000. The 1,000 that you have returned to me as the seller, it becomes sales returns. So to the business sales returns, it is the value of goods that were initially sold, but they have been returned by the customers. So they are considered as sales returns. They are the ones that are debited in the sales returns account. And then you credit the customer who is returning them. For the purchases returns, we had purchased goods from our suppliers. Remember, you purchase from suppliers, then you sell to the customers. So the goods that we purchased from the suppliers, we have returned them back. Some of them, not all of them. We return some of these goods to that particular supplier. They become purchases returns. We had purchased initially, but later on we return part of the goods. They become purchases returns. These are the goods that we have said will be credited in the purchases returns account. And then you debit the supplier to whom you have returned. That's all. Remember when you purchased, you credited the supplier. And then you debited purchases. But when you return them, you will credit the purchases returns account. The account that you had credited for the supplier, you debit that now supplier again.
Okay.
Clear?
Yes, sir.
So for balancing, it is simple. For each and every ledger account, identify the side with the less and the amount by which it is less. Like capital account, if you look at it, credit side, we have a total of 290,000, but on the debit, we don't have any amount. So it is nil. So for the balancing, then the debit should also have 290,000. So that we have 290 on credit, 290 on the debit. The figure that you are inserting so that the two sides can agree, we refer to it as balance carried down or balance brought down. This is the figure at the end of the period. So these were the transactions for the month of May. So by the end of May, the balance of each and every account will be defined as the balance carried down. So for capital, the balance carried down is debit of 290,000 because that is what is missing on the debit so that the two sides can have the same total. So this is what you do. You add this, you say it is 290,000, close with the double lines. Then go to the debit, the figure that is missing so that it can total this. Use the last day of the month, or it balance carried down to 90,000. So by doing so, this total also will be now to 90,000. Then remember, when we start the new month, this was May. When we start June, the closing balance for May will be the opening balance for June. And remember, this is something that occurs within hours. We close the business today. This is the end of the May. Then it simply means that tomorrow morning, it will be 1st June. So the balance that we close with today is what we shall start with tomorrow, which is the new month. That balance, like for the capital, it is a credit balance. The balance carried down has been placed on the debit just for balancing purpose. But that balance is considered to be credit because it is the credit side that had 290. The debit side had nothing. So the balance belongs to the side that had more. So it is the credit that had more. So when we start the new month, it will be now the balance brought down. Like the first of June, balance brought down to 90,000. It is the same amount that you carried down. And I want you to follow these basic rules. Make sure that the totals are on the same line, horizontal line. Don't have this one up here and the other one down here. Make sure they are on the same horizontal line. And make sure that there is a line and 2 lines below. A line at the top and 2 lines below. Then the balance brought down should be just below the double lines. Just below the double lines. Don't improvise your own way of balancing the ledger accounts. Make sure that the totals are on the same line. Then the balance brought down will be taken to the side that had more than the other side and put it below the double lines. As neat as that. Okay, let us go to the cash account. Cash account, it is now debit that is having more than the credit. So you do the same. This is 240,000. Close that. When we now close the month of May, that year of May, because here we don't have 240,000 is missing here, we consider it as balance carried down to 40,000. Then put it here as a total to 40,000. It is the debit that had more than the credit. So the beginning of June, it will be our balance brought down here. The carried down balance will be the brought down balance on the debit. We go to the bank. Debit has got 90 plus 120, that is 210,000. Credit has got 100,000, 50-50. So this side has less. Less by what? 210 minus 100,000. There is a deficit of 110 on the credit. So that the two sides can be 210 to 10. That figure of 110 is going to be our carried down. We received 210 in the bank. We spent 100 in that bank. There is a balance of 110. So we are putting it here so that it can balance. So it is going to be our balance carried down 110,000. So that here it can be 210,000. This side can also be 210,000. This 110,000, it is going to be a debit balance because it is the debit that exceeded the credit by 110. It is a debit balance. Or the other way of understanding it, there is no single day the carried down and the brought down will be on the same side. Like in capital, the carried down is on the debit, the brought down goes to the credit. On the cash, the carried down is on the credit, the brought down goes to the debit. But the concept is that the balance belongs to the side that had more. Furniture, there is this is 30th of May. The balance carried down will be 50,000, so that the two sides can agree at 50,000. Here at 50,000. This is a debit balance because it is the debit that had more. So 1st of June, the balance brought down 50,000 goes to the debit. Furniture account, sorry, home furniture. This is now the supplier of the furniture. Home furniture, the 50,000 is on the credit, nil on the debit. So for balancing, we shall have to introduce a balance carried down 50,000, so that we have 50,000 there. We also have 50,000 on there. If carried down is here, brought down comes here. Half of June. So we are done with balancing the first column of the reg accounts. We proceed to the other side. Rent account, debit 50, bill on the credit. So as at 30th of May, the balance carried down is 50,000 on the credit. So that we have there 50,000. We also have there 50,000. Carried down is your pandela, 1st of June, the balance brought down. Now I'm going to move a bit faster. So you have understood the concept. Here I have 160,000. So it is going to be my balance carried down. The carried down becomes the brought down on the opposite side. 60,000 on the credit, 4,000 on the debit. So here, for balancing purpose, 56,000 must be added here, so that we have 56 plus 4 to add up to 60. So brought carried down is here, 1st of June. Balance brought down. Carried down is your upper brought down goes to the other side. And you use the same amount. So others have seen a case whereby you write balance carried down 56, but when you come to balance brought down, you use the total, which is 60. No, you use the same figure that you carried down. Carried down is the figure you close to. Brought down now, it is the figure you are starting with. So brought down is the figure to start with. Carried down is the figure to close with. So the figure you close with is the figure you start with. 30th of May, the balance carried down 40,000. Each up and day, 1st of June, is going to be our balance brought down 40,000. Credits. Purchases returns 4,000 May. So 30th of May, balance carried down 4,000. So carried down being here, 1st of June. Then we finish. Balance carried down will be 100,000. So here we have 100,000. Carried down being here, 1st of June, it is going to be brought down. Amity Bank. Carried down being here, 1st of June. Drawings carried down becomes the brought down on this side. That is the end of your age accounts. Yes, for carried down, we normally use the last date of the month. The last date of the month. Before you start now the new month. Not the last date of the transaction, the last date of the month. That is or that first or 28th or 29th. That is it. So I want us to go an extra mile and prepare the trial balance. In this question, you are not supposed to do that. You are not supposed to do a trial balance. So don't take it like when you are told to prepare the ledger accounts, you do up to the trial balance. No, you just do the ledgers. But now I want to demonstrate that anytime you observe double entry, then the trial balance should be balanced. So we have done the ledgers. I want us now to go an extra mile and do a trial balance. So this was the business of tender. Tender Enterprises. Trial balance as at the last day. So you just list all the accounts that you open. You had the capital, cash, bank, you have furniture, you also have home furniture, you also have rent account, purchase account, jewelry account, sales account, purchases returns, MEMA, drawings, an easy first of all, and then drawings. So what you do with it, you take the balances brought down. The balances brought down are the ones that are on the correct side, not the carried down. The carried down, they were only replaced for balancing purpose. But that balance was taken back to where it belongs. For capital, it was taken to the credit side because it is the credit that had more than the debit by 290,000. So that 290,000 is a credit balance. For cash account, the brought down is to 40,000 on the debit. So you put it in the trial balance on the debit. For the bank, brought down is 110,000 on the debit. So use the brought down. Don't use the carried down. The carried down was temporarily placed there for balancing purpose. But the correct position is that it is normally taken to the side that exceeded that other side. So I'm going to take them the way they are. Capital is a credit of 90,000, so I credit on the credit. Cash debit of 40,000. Bank, it is a debit of 110,000. Furniture is a debit of 50,000. Home furniture is a credit of 50,000. So you put it on the credits. Rent is a debit of 50,000. Purchases, it is a debit of 160,000. Jewelry, credit of 56. Purchases returns, sales, credit of 40,000. Purchases returns, credit of 4,000. Then we have got MEMA credit of 100,000. Then Ufanizi credit of 120. We finish with the drawings debit of 50,000. I've just taken all the balances brought down and the corresponding side where they fall. So if everything is well, if there is no arithmetic error, and we have observed the principle of double entry, then the totals of the debit and the totals of the credit should agree. We should have the same figure. We should have the same total on each side. So you can confirm that. Just do the addition very fast. Then you tell me whether they are coming into agreement.
Mwalimu, the bank debit, should it be 110 or 210?
Which one?
Bank.
We are taking the balance brought down 110. We don't take the.
Oh, okay.
We take the balances, don't take the totals. Can somebody confirm that they are in agreement?
Mwalimu,
Yes.
yes, 60,000.
660,000. 660,000?
That's what I got, sir.
Okay. I hope the others are also getting the same. So the moment they are in agreement, then it simply means that your work is correct and it is accurate. You have observed the rule of double entry. Double entry is everything. For every amount that you debited, there is somewhere else you also credited the same amount. So for every debit, there was a corresponding credit entry of the same amount. If for every debit, there was a corresponding credit entry of the same amount, or for every credit, there is a corresponding debit entry of the same amount, then the total debits should be the same as the total credits. And that's why the trial balance should be used to balance. So if you have done some mistake somewhere, either you debited, you forgot to credit, or you credited, you forgot to debit, you have done single entry, the trial balance will never balance. If you do a case whereby you have debited by 100,000, you have credited by 10,000, again, it will not balance. If you have done some arithmetic errors in the process of balancing, when you are getting your balances carried down, you do some arithmetic errors. You add wrongly, you subtract wrongly, again, your trial balance will not balance. But if you are keen, you are accurate, you observe the double entry, you make sure that you use the same correct amounts to debit and credit, you balance your arrange accounts correctly, then your trial balance needs to balance. So you need to have that understanding. The trial balances simply because of double entry, and making sure that you do or you use the correct figures for both accounts. So in some instances, you can be told to prepare a trial balance without necessarily preparing the age accounts. I've seen those questions even in your past papers, whereby you are told to prepare the trial balance from the following balances. So when you are presented with such a question, it should actually take you not more than 5 minutes to prepare the trial balance. If the balances have been provided to you, then less than 5 minutes you are supposed to be done with that question and get your 10 marks because of the rules that we have been discussing about here. The trial balance has got the accounts. we have the accounts, the debit balances, and the credit balances. So by now, you need to have this in your mind. Don't forget to have the type of your trial balance, the name of the business, and the date when you are preparing the trial balance. For the date, it should be as at the date that you are given in the question. It must have the heading or the title. The name of the business, trial balance as at this. So we have got this, all the assets, they are going to be on the debit side, whether it is motor vehicle, machinery, debtors, cash, bank, or asset, any asset to be on the debit. Or expenses to be on the debit. Rent expense, insurance expense, electricity expense, repairs, maintenance, salaries and wages, and all of them, put it on the debit. The other thing that to debit is the purchases. Put it on the debit always. Put it on the debit. The other thing you debit, draw it. Always debit. The other thing, go to sales returns. Also known as return inward. So, and these items in the ledger accounts, we normally say that they are increase with debit, increase in asset debit, increase in expense debit, purchases when you acquire them debit, drawings when it occurs debit, when sales returns occurs you debit. So at the end of the day, they will have the debit balances. So if you are given them as balances without doing the ledgers, put them on the debit. What do you credit? You credit capital. You credit sales. You credit liabilities. You credit purchases returns. Also known as return outwards. All those are supposed to be. And also the revenues. The revenues. The revenues are told you they are the rights of the discount received, rent received, commission received, interest received. Those are revenues. That is the rule. And you agree with me that these are the items that we normally say that either they are always credited or their increase is normally credited. Capital, when it increases, is credit. Liabilities, when they increase, is credit. When sales is always credited, purchases, returns, always credited. The revenues, they are also credited. So in the trial balance, their balances should be on the credit side. Actually, that is the format. If you have it right, it should not take you even 5 minutes to do this because the balances are there. You just write there, furniture, you put it on the debit because it's an asset. And if you look at our trial balance here, that is what is happening. Capital for credit. Cash is an asset debit. Bank is an asset debit. Furniture is an asset debit. Home furniture is a liability because this was a supplier that supplied on credit. Credited. Rent is an expense debit. Purchases is debited. Jewelry is a liability because it's a supplier, a credit supplier. Credited. Sales is always credited. Purchases returns credited. Member is a liability because it's a supplier. So this is a credit, credit. And then Fanizi is also, this was a loan. This is a long-term liability. Liability is credit. Drawings is debited. So that is the case. So Member and the jury are actually the people we call the creditors or accounts payable. They are credit suppliers. We owe them. So that is basically what I wanted to tell you today. That is what I wanted to tell you today. And I think the message is home. Can we end the class at that point?
Yes, Mwalimu.
Yes, you can. There is question 2. That is for your own trial. You can try that. Sorry? I can't hear you. I can't hear you clearly. Huh?
I'm saying kindly share the recording.
I will share. I will share.
Thank you. Thank you.